You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. This past week, wow, it threw everything at global markets, didn't it? We saw massive policy shifts, aggressive tariff threats, major currency swings.
A lot to unpack.
Definitely. So we've pulled apart our sources, the articles, the data to give you the shortcut through all that chaos. We've got a pretty dynamic deep dive planned for today. We're going to kick off with the foreign exchange market, where some surprising rate moves really set the early tone.
Okay.
Then we'll jump straight into that defining trade shock, the one that hit late in the week.
Right, the tariff news.
Exactly. And finally, we'll look at how commodities reacted, how they acted as sort of the ultimate macro barometers for all that political and policy noise.
And our mission for you, the listener, is pretty simple, really. We're cutting through the noise here to arm you with the market's, let's call it, psychological filter. You absolutely need to know how professional traders distinguish between, the political shouting, all the rhetoric, and what's actually codified, binding law, the rulemaking.
That distinction is key.
It really is. That single difference basically defined this week's turbulent reactions.
All right, let's dive in where the action started in the FX market. What's fascinating, I think, is how the initial moves got amplified, significantly amplified.
Yeah. Why was that?
Well, because we had really low liquidity. Think about it, global holidays everywhere. Japan's Sports Day, U.S. Columbus Day, Canada's Thanksgiving.
Right. All overlapping.
Exactly. Which, frankly, left trading desks looking a little thin.
Okay, that makes sense. So low staffing meant those initial gaps, those opening shifts, they just stuck tighter than usual.
Yeah.
Magnified the drama.
Precisely. And the Japanese yen was our first major signal there. We had a decisive leadership outcome in Tokyo, which kind of settled domestic policy expectations.
Reinforcing that pro-growth fiscal spending sort of tilt.
Yes. And that immediately translated to FX purely because of those expectations. Japanese yields, they stayed comparatively anchored.
Which does what to the rate gap?
It instantly widened the interest rate gap versus the United States. And that mechanical backdrop just pulled the USD-JPY pair higher.
Simple mechanics. Money flows to yield.
Always does. And the U.S. offered a wider gap this week. Simple as that.
But there's always a but, isn't there? There's a nuance.
Go on.
Well, coalition strains immediately complicated that read-through. Markets actually saw two-way swings as traders tried to figure out just how difficult it might actually be for the incoming administration to push those big fiscal plans through.
So policy continuity was priced in, but the execution risk, that created the chop.
Exactly. Well put.
Okay, let's shift over to the euro. It stayed soft, but surprisingly contained, wouldn't you say? It seemed kind of caught.
Caught between what? Political uncertainty and uneven data.
Yeah. What was really capping any meaningful upside seemed to be that uncertainty injected by France's government reshuffle and all the back and forth around the prime ministership.
Right. That political noise alone was probably enough to keep a lid on things, even when risk appetite was, fairly steady elsewhere.
Did the data help at all?
Well, we did get some important euro area data, things like the German ZW expectations. That's a key forward-looking sentiment index.
Right.
And the final HICP inflation numbers. It offered some texture, maybe, but not really a catalyst.
So the focus remained on manufacturing.
Yeah, the real focus was still on whether that manufacturing softness was still deepening or if it was maybe possibly stabilizing.
So if we synthesize the EUR message, it's political volatility plus that uneven industrial momentum. It just keeps any rallies pretty shallow.
That's it. Hard to build upward momentum when the underlying growth story is, well, questionable.
Okay, now speaking of policy surprises, let's look down under, almost, the Kiwi dollar. We saw a massive, unexpected shock there.
Oh, yeah. The Reserve Bank of New Zealand delivered a, staggering 50 basis point rate cut.
Huge move.
A shock move, absolutely.
Yeah.
But interestingly, the RBNZ intentionally tried to soften the blow. They framed the decision as front-loading the policy action.
Right, trying to signal this wasn't the start of some deep, long easing cycle.
Exactly. They wanted the market to think, okay, big cut now, maybe fewer later.
And the market reaction, it initially tried to rally on that nuance, right, on that more optimistic tone.
It did, briefly.
Yeah.
Betting fewer cuts were coming down the line. But that rally faded hard.
Wait, why? If the RBNZ was clear about just front-loading, shouldn't that have maybe stabilized the currency a bit more?
You'd think so, but here's the thing. When the domestic activity backdrop is fragile, policy action, the actual 50 basis points cut, it completely overwhelms the policy tone.
The front-loading rhetoric just didn't matter as much.
Not when fear of immediate severe domestic weakness kicks in. That trumped any hope about the future path of rates. That's the crucial takeaway here, I think, for listeners.
Action beats words.
Every single time, especially when the economy's looking shaky. And maybe just a quick sidebar on the Aussie dollar. It's really just a passenger right now. It's tethered largely to those China-sensitive growth signals. Everyone's just waiting, watching closely for the upcoming labor data and that October CPI print. That'll determine its next move.
Okay, got it. So that focus on policy action was immediately put to the test late in the week, wasn't it? We have to pivot now to the defining shock.
The trade tension escalation.
Yep. And true to form, it landed late Friday, just as global liquidity was thinning out ahead of the weekend.
Classic timing. Magnifies the initial reaction.
So Washington signaled an intent to slap a staggering 100% tariff
100%.
on all Chinese goods. Not some select list, all of them, starting November 1st.
And the stated reason. Direct retaliation for Beijing's decision to tighten export controls on rare earth materials.
The market didn't just react to the number or the 100%. It reacted violently to the scope, right, and the suddenness.
Absolutely. This forced an immediate and probably painful reassessment of already strained supply chains just across the board.
Now, we did see the rhetoric soften a little bit over the weekend.
A bit, yeah.
But that brings us straight back to our core premise, doesn't it? The market is now laser-focused on whether this threat converts into actual rulemaking.
Policy matters far more than a late Friday headline dump. Always does. And what's really fascinating here is that this tariff threat isn't happening in a vacuum. It's not isolated.
How so?
We're seeing parallel geopolitical moves. Washington is apparently probing potential workarounds to current chip restrictions and floating new export frameworks with Gulf partners. At the same time, Beijing is reportedly tightening its customs scrutiny on imported AI processors.
So it's a multi-front conflict zone now. Semiconductors, critical minerals, shipping lanes, they're all squarely in the crosshairs.
They really are.
What does this intense friction mean for the macro landscape, beyond just the immediate hit to equities?
Well, the consequence is a definite knock-on effect for FX. You'll see it via terms of trade shifts.
Yeah.
And maybe most importantly, for commodities.
Right, through downgraded demand expectations.
Exactly. The trade war is now operating on multiple, highly technical fronts. It's way beyond just standard manufactured goods tariffs now.
Okay, that brings us perfectly to commodities then. They really acted as those macro barometers, didn't they? Their price action just echoed all the policy noise from the trade headlines.
A very clear reflection.
Let's look at oil first. It slipped. Why?
Well, traders immediately marked down global growth expectations. That was the direct response to the massive tariff threat.
Okay.
And they were also positioning ahead of the upcoming OPEC and IEA monthly reports. Those always carry weight.
So was the drop more about positioning into that headline risk, or was it fundamentals shifting?
From what we saw, that oil drop looked very much like positioning against headline risk, rather than some sudden shift in pure supply-demand dynamics.
So the direction from here depends on?
It depends entirely on whether those trade tensions actually escalate into codified policy, or if they cool off quickly.
Got it. Now, copper told a similar story, maybe even cleaner.
Yeah, copper often does. It showed some initial resilience earlier in the week.
Based on what? China, maybe?
Likely based on some perceived domestic industrial resilience from China, yeah. But that strength quickly gave way to a sharper drop once that broader risk-off narrative really took hold late Friday.
So copper is the clean barometer here.
I think so. Yeah. It tells you almost exactly how traders are handicapping global manufacturing, global electrification demand, especially in a world where tech and mineral trade is getting demonstrably tighter, more fragmented.
And finally, gold. We saw that familiar pattern again. Surge to records, sharp pullback.
And then it steadied itself as the dust settled a bit.
Gold fundamentally just reaffirmed its function, didn't it?
Absolutely. Gold functions as the ultimate policy release valve. It's firm when major shocks hit, like that tariff news. It calms down when the rhetoric cools off a bit.
And it's always sensitive to the dollar and yields.
Highly sensitive to both the dollar's path and, crucially, real yield expectations globally. It's just the essential hedging mechanism for chaos and uncertainty.
Okay, so now we come to maybe the most critical point, the macro psychology that ties this whole week together. Despite the shock, a potential 100% tariff on all Chinese goods, why did volatility stay surprisingly contained, especially in FX and rates?
You'd expect more panic, right?
In a prior decade, you'd expect pure visceral panic, definitely.
It's a really crucial question, and I think the answer lies in market conditioning. Years of it.
Okay.
Traders treated the shock as highly disruptive, yes, but, and this is key, not yet regime changing. It reflects, like I said, maybe a decade of conditioning now to fade these political flare-ups unless and until they turn into solidified, codified policy.
The threat isn't the law.
Not yet. And until the law actually changes, positioning remains, well, anchored to the current reality.
That restraint also reflected the calendar, didn't it? With the U.S. CPI data coming up.
Exactly. The Bureau of Labor Statistics is preparing to publish the September CPI, so traders preferred to anchor on those near-term inflation prints and, the central bank reaction functions that follow.
Because the data is real, the tariff threat is still theoretical, at least from a rulemaking perspective.
Precisely. And consensus heading into those reports, it looked for a slight cooling in U.S. core inflation.
Right.
Which just reinforces the market's view that policy is probably easing leaning, but still fundamentally data-dependent. The data still drives the Fed, and the Fed still anchors global rates and FX.
And we shouldn't forget the underlying asymmetry we see in Europe and the UK.
Oh, absolutely not. Domestic growth challenges over there, plus some tough fiscal arithmetic.
Yeah.
It keeps the FX responses asymmetrical for the euro and the pound sterling. Meaning weak data bites harder than strong data helps. Those structural issues in domestic growth, they prevent any strong, self-sustaining rebound from really taking hold.
Makes its currencies particularly vulnerable to negative surprises.
Exactly. Gives negative momentum a much easier path.
So, wrapping this all up, what does this mean for you, the listener, as you head into the new week? Let's summarize the action items, the things you need to watch to track the follow-through. First, keep a close eye on the yen's sensitivity, both to Japanese political signals and any surprises, especially upside surprises, in that upcoming U.S. inflation data.
Right. Second, watch the Kiwi dollar's follow-through after that big RBNZ cut. Does the policy action actually stabilize the domestic economy like they hope? Or does the currency just continue to fade?
Good one. Also, track sterling's reaction to the upcoming UK labor and price data. That'll be key.
And finally, look at energy and metals. See how they track the official agency outlooks OPEC, IEA, and crucially, any fresh regulatory guidance from Beijing, especially regarding those rare earth materials.
That'll tell us if Friday's commodity pullback was just short-term positioning or maybe something more durable.
Exactly. And we just connect this back one last time to the bigger picture, the trade shock.
Yeah.
The most crucial element right now isn't the political shouting matches. It's not even that late Friday headline that sent the market reeling for a bit.
It's the conversion.
It's the conversion of the tariff threat into the actual rule book. Concrete, irreversible steps on tariffs, on chips, on critical minerals. That is what will determine the true lasting tone for both FX and commodities for months to come.
That's the powerful lens you need to use going forward then. Is this just rhetoric or is it actually rulemaking? If you can spot the difference.
You can spot the pivot.
Indeed. That was a serious deep dive into a chaotic week. We'll catch you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.